Hello, everyone. I'm Meher Walia, and welcome to Finding Finance, the podcast where we delve into the different subfields of finance. This podcast aims to help high schoolers who are contemplating a career in finance understand the different paths in the world of finance and help them find which path interests them the most. Our esteemed guest today is Ravi Anand. Mr. Anand's current role is the head of private real estate credit at Wellington Management. Prior to this, he was the executive vice president at Pimco from 2018 to 2024. Wellington Management Company is a private, independent investment management firm with client assets under management totaling over $1 trillion. Pimco focuses on traditional fixed income. Wellington is similarly a distinguished asset manager diversified across fixed income and equities. Today, we are going to dwell in the world of real estate. I hope you enjoy our conversation with Mr. Anand. Mr. Anand, thank you for joining us today. It is a pleasure to have you on the show.
Well, thanks, Meher, for having me. I do have to mention I'm really excited to join you on this podcast, but most importantly, I'm really impressed by what you've done with this series and so glad to be part of it.
I appreciate those kind words. Let's start at the very beginning. Take me all the way back to your upbringing. What was life like for you growing up?
Yeah, so Meher, my family immigrated to the United States when I was in second grade. So all I've known is the U.S. effectively. I grew up in Flushing, effectively a working class community, quite heterogeneous. I think back then I was referred to as a melting pot of different ethnicities, religions, cultures. I grew up in a family with two elder sisters and a younger brother, and Flushing was great. I got exposure to not only my large community, which was both Indian and from the Sikh faith community, but also across the Asian community, whether it was Koreans or Chinese or blacks and Hispanics. It was quite diversified and really, really a melting pot, as it was described. So it was quite fun.
What were some of your favorite subjects in schools, or did you have any hobbies when you were younger?
Yeah, look, I think when you're growing up in a place like Queens, it's not as coordinated as far as activities are concerned. It's a little tougher given the density of the community, but I think your first question is what were my subjects. I did fairly well in math and science. I think humanities and arts were probably something that didn't come to me as naturally. I think part of that is probably based on what we saw at home. My parents were hardworking entrepreneurs and, really focused on work and building a business. So you didn't really get to explore the arts and museums. And candidly, I think back in the early 80s, kind of some of these softer skills or call it arts and humanities and music were certainly not well curated in the schools as they are today. They're better appreciated. Maybe that's part and parcel. Maybe I'm making an excuse. But finance is what I do now, but math and science kind of came naturally to me, and I did well in it and kind of gravitated towards it. You asked what my hobbies were. My hobbies were not that kind of wide. I really wasn't a great sportsman, but I did get to play in our building's parking lot with either my friends or kids in the building. I played stickball and two-hand touch football, and I don't know how to swim. We didn't have pools in our buildings, and it wasn't really encouraged in school. So I did a lot of just stuff you do in and around the neighborhood, hanging out with friends, going to the park and playing basketball. That I would say that was probably my biggest hobby back then.
Yeah, basketball is a great sport and one of my favorites as well.
Yeah,
to play and watch.
You're probably better than me, though.
For undergraduate school, you attended New York University's Stern School of Business, graduating in 1998. What was business school like? And how did business school help you on your path to finance?
I'll start by, mentioning that I was fortunate to gain acceptance into NYU, but it wasn't into the Stern School of Business. It was into the College of Art and Science. And that's because I planned on majoring in bio, and I was a pre-med hopeful. And I say pre-med hopeful because my parents hoped that I'd become a doctor. But I found quickly that medical school likely wasn't going to be for me. Part and parcel of that was the fact that I got a D in honors bio, so that was a limiting factor. But when I got to NYU, I got exposed candidly to the world of finance, to investment banking, to sales and trading, to all these other classes and peers that were not in the arts and science school but were in the business school, who had more exposure, the type of exposure, candidly, you're trying to give your peers in high school today. They had exposure already to other aspects of being a professional. See, for my parents, a professional was a doctor or a lawyer, and they guided me towards the medical profession path very early on. They didn't have this wide exposure to other professionals in our community that were in finance, or their friends even in finance. So I made friends pretty quickly, and they had that exposure, and they were able to kind of show me, quote unquote, the light of other opportunities outside of what may be deemed a professional. So I quickly realized that, I enjoyed, as I mentioned earlier, math. I enjoyed some of the aspects of what I was learning quickly in New York around being a finance professional. And I was lucky again and fortunate again that NYU had this business school that I could apply to and transfer into. So your question was, what was business school like? Business school was great once I got in. So I got in after my second year. So I joined in my third year of college, and that's when I started really focusing on finance and accounting and operations management classes, and business law, which was one of my favorite classes in undergrad. I really started enjoying stuff, and I started seeing stuff that really, for lack of a better way to say, clicked with me better.
After you transferred to the business school, were there any fields of finance that you initially wanted to pursue?
I think you're making the point that finance is very, very wide, right? I don't think there was anything I really particularly wanted to focus on, but I did realize early that back then, and I think it's different now, back then, for a lot of young people who had many big corporations coming to a school like NYU to recruit, investment banking was something that that people focused on or gravitated towards. And so I too similarly wanted to be an investment banker coming out of school. I didn't really know what that meant, but what I did understand quickly was it helped give a young professional, a young person, exposure to seeing whether it be M&A, mergers and acquisitions, or how companies are capitalized, whether it be with debt and equity, helping companies like where I work now engage in trading from a sales and trading perspective. I realized that if you were able to find a way into a training program at one of those investment banks, it could help set the stage for you to learn the skills from an analytical perspective, from a critical thinking perspective that can maybe open doors into finance. I think that's changed now, but that's where I thought I saw myself gravitating to back then.
So you felt investment banking in the entry level laid a good foundation for whatever else you wanted to pursue in finance in the future?
That's what I thought then as a 18, 19-year-old coming out of school, because that's where the larger, more meaningful, Bear Stearns used to exist then, Solomon Brothers used to exist then, and then you had Morgan Stanley and Goldman Sachs and all these big firms. They would come onto campus, and they were the more sought after jobs. So you thought, okay, that's where you're going to learn the most. So you should try to focus there as well. It was kind of there wasn't a ton of precision to it. It was just more like, this is what is the hardest to get. So sometimes you think something that's really hard to get is what you should go after.
I see. So later you went back for your MBA at Columbia. What drove that decision, and what did you take away from it?
Yeah, I went to Columbia much later than most MBA students would go. Typically, I've seen most people want to go back to business school because, one, they didn't have an undergrad business degree, and they didn't learn the disciplines of accounting and finance in an academic setting. So they want to go to business school to gain those skills and then propel or continue their career. The other reason I saw folks want to go to business school was because they want to change careers. They were an engineer and now they wanted to be in business and finance. They were a doctor and they wanted to now be in business and finance. I actually took the path later in my career in an executive program at Columbia. And the reason why I did the executive program at Columbia was because I didn't want to, I already had a finance background, and I already knew that I wanted to stay in real estate. So for me, going back to business school at Columbia in an executive program was really to expand my network, to get, I guess in some ways, a stamp of approval on my academic background, and then to hone in on some skills that were better, you're better worse than honing in after you've had some experience. So it was a combination of career progression, honing on some skills, expanding my network, getting the credentials of a business school that led me to Columbia. And it was, again, NYU was great from an undergraduate perspective, and go to business school at Columbia was just as rewarding.
Are there any skills you say you would have taken away from that experience at Columbia?
I think I certainly expanded my network in a material way. That's for sure. I also had a better appreciation of some of the basic classes or the intro classes you take in undergrad that you also take in business school, like Accounting 101 or Finance 101. When you're taking these classes at 19 years old, right, when you're an undergrad, but you haven't really worked at a company, and then you're taking these same classes because the fundamentals are the same after you've worked for 10 years, you have a different appreciation. The application of what you're learning is more apparent. And the dialogue, especially if you go to a business school and an executive program, the dialogue that you can have within the class, not just with the professor and the peers, is a ton more meaningful and can really help you evolve your thinking around some of the learnings of from academia.
As you mentioned before, you knew you had an interest in real estate and decided to pursue that throughout your career as your main focus. What are the different classes of real estate?
Yeah, so first mention on real estate. I wasn't in real estate out of school because I wanted to be an investment banker, and then I was part of that cohort that came out of school just before the tech crash of 2021, and a lot of us were out of work or needed to change paths because the economy had just taken such a big hit. So I at that point needed to decide what I wanted to do long term. I actually applied to business school back then, and there was only a couple schools I wanted to go to, and I didn't get into. So remember I said you want to go to business school because you want to change your path. So I tried to take that approach, but it wasn't fitting then. Then I told myself, okay, what do I want to do when I grow up? And when I went to undergrad and looked at all kinds of sectors and industries, nothing, nothing kind of felt easy to me, or felt more natural to me from understanding how it works. So when I say how it works, like how an automotive company works, or how a chemical chemicals company works, or a paper and packaging company works, how a real estate company or real estate asset works kind of came naturally to me, right? Like if you think about, you'd asked about sectors. If you think about it, we all touch real estate, right? I used to live in an apartment building. It was a rental apartment building. Well, that's a sector. Housing and multifamily rentals is a sector in real estate, in commercial real estate. So I had stayed at a hotel, another sector in commercial real estate. My dad worked in an office. I had been to an office, whether it be a traditional office or a medical office. Those are also sectors in real estate. So that led me to say, hey, I want to do something in real estate. So I started pursuing opportunities there. But to answer your question around sectors in real estate, there's the big sectors are office, which is facing a ton of structural challenges because of a paradigm shift in how we office post-COVID. There's housing, which can be apartments for rent, it can be student housing, it can be single-family houses that are for rent, it could be houses today that are built just to be rented, so that's housing. There's industrial and logistics, and within that, there's many classes, but that's a big sector. Hospitality is another sector. And then there's what we call more niche sectors like self-storage, life science, medical office, and one very large growing sector is data centers because of the growth in computing needs for AI and other kind of cloud-based services.
So would you say data centers is the asset class that's currently booming?
Well, I think the fundamentals across most real estate sectors are fairly sound. I think the growth in data center is obviously very, very clear in your face. But I think booming is probably not the right way to think about it. I think it's certainly growing. And if you meant growing by booming, then I agree with you because the needs for the amount of data center space are much larger than what exists today. So I guess it is booming. I come back and I agree with you. But I think the fundamentals of most other sectors are still fairly strong. When you think about housing, we're short in total supply. When you think about industrial and logistics, companies like Amazon and all these other large providers of goods need to get closer to delivering that good to your house and mine. So the fundamentals, when you think about these real estate sectors that are tied to what I call the digital economy, are also kind of have tailwinds behind them.
What are the differences between the debt side of real estate versus the equity side of real estate?
Well, the way to think about it is when you buy an apartment building or an office building or a hotel, you the owner, own the equity interest in that asset. So that's the equity side. Often, because real estate is a very capital-intense sector, you have to borrow money to be able to buy that apartment, office, industrial, hotel. So the difference is just the lender is considered the debt side, the owner, who is the borrower of the lender, is considered the equity side, to put in simple terms.
I see. So one's lending, one's borrowing. Lending's debt side, borrowing's equity side.
Correct.
In 2003, you joined Sterling Equities as an acquisition senior associate. Was this your first exposure to real estate?
Joining Sterling wasn't my first exposure to real estate, but it was my first meaningful exposure to real estate. I joined a team that was responsible for investments. So we were on the equity side of the business. And our role on the team was to go and assess and what we call underwrite, which is figure out if we want to buy something, how much do we want to buy it for, what are the considerations around the property that we want to buy that we need to consider that go into our compute to what we want to pay for it. And then what kind of debt can we get for it, right, as equity side or owners. So it wasn't it wasn't my first exposure, but it was my first meaningful exposure, and it was a very significant exposure because I later went on, as we'll talk about, to be a lender or on the credit side. But to be a good lender or to be successful on the credit side, you really have to understand how to value, underwrite an asset because that is your collateral. So if something goes wrong, you can only get your money back as a lender if there's enough value in the real estate that you lent against. So you have to be able to understand how to value it. So my experience at Sterling was phenomenal for my career because I got to work with some great people who had a ton of experience owning real estate assets for a long, long time, and they taught me what to look for in an apartment. So like I always give the example, I'd often go to a different market to look at what they call comps, comparables. So how do you know what to estimate for the rent for a 2-bedroom apartment in the building that you're looking at? Well, you go look at other similar buildings in the neighborhood and what are those owners charging for that unit, and how do you go find out what they're charging? Well, you go and quote unquote shop them. So you pretend like you're a tenant, right? And you say, hey, I'm looking for an apartment and I need a 1-bedroom. And they show it to you and you get an idea of what they're charging for. And you kind of normalize, you say, hey, this one has a pool, the building I'm looking at doesn't have a pool and they're charging $100 more. Might be worth it, to pay $100 more for this building with a swimming pool while the other one doesn't. And then sometimes you have to be a little sneaky and, actually we had to be sneaky back then. Now everything's on the internet and information is a lot more prevalent and easy to access. And say, hey, can I just look at a 1-bedroom also? I just want to see what the other side view looks like. And then you get a sense of all the 1 and 2 bedrooms, and then maybe 1 and 2 bedrooms are like 80% of your pool of units in the building you're looking at, and you have enough to kind of assess what to underwrite for rent. So those type of instances were a great learning experience for someone to be an investor in real estate.
You mentioned collateral before. Do you mind just giving a brief explanation of what collateral is on the lending side of real estate?
Yeah, sure. So earlier I explained to you that if you go and buy a building, you're the owner. And then if you ask someone to give you part of the money to buy it in a loan, they're the lender. The lender gets from the owner a specific interest payment, and that's all they get. And then after a while, they get their principal, their loan amount back. But to the extent that the owner is unable to pay the interest, unwilling to pay the interest, maybe they turn out to be a bad person and don't want to pay the interest. the legal structure works is that a lender has a claim to the physical asset to the extent that the owner is not doing what they contractually agreed to do. Thus, as a lender, we have collateral interest. So the building that the owner owns is our collateral for the loan that we're making. Does that make sense?
Yes.
Okay.
So you could sort of take. So if they don't pay, you could take that collateral and seize it as your own.
There's a process, but yes, is effectively how you would think about your own home, right? Most people don't buy a house without a mortgage. So you have a mortgage lender. The mortgage lender collateral is your house. So if you don't pay the interest back, the interest and the principal back, then a lender can foreclose you eventually, ask you to leave or force you to leave, and then they can sell your house and try to recover as much of the principal as possible.
After Sterling, you joined GE Real Estate as the Senior Director of the Strategic Capital Group. Were you practicing the same asset class of real estate as Sterling, or did you switch classes? And if so, why?
Yeah, so asset classes are the type of real estate. My investment focus changed. So before I used to work for an owner, now I worked for a lender. So what changed was, from my experience at GE onwards, I became a lender, a credit officer, someone who extended credit to owners, made loans to owners. So that was the big switch. GE was a phenomenal, GE Capital was a phenomenal business. It was very, very large. It had been in the real estate business for nearly 3 decades, and it had both a business as an owner and just as large a business as a lender. The reason why I joined GE on the lending side or the credit side was candidly to round myself out. I always knew that to grow in real estate, I needed to understand both sides of the equation, if I may call it that. And to join GE, which was a very large, I mean, its business was almost $90 billion back then. If I could round myself out on the credit side, I could then later understand how a lender thinks, what are their considerations, grow in experience by way of relationships and connections, and understanding of markets and different asset classes. Because at GE, we did more than what we did at Sterling from an asset class perspective. Fortunately for me, I really found what I liked doing better. And I was able to grow over those years and stay in that segment of the larger real estate asset class, which was as a provider of credit, as a lender.
I see. So it gave you a new perspective on understanding the lender's point of view and their motivations.
Yeah, that a ton more. Just just that G was a much bigger platform than Sterling. It was global. It was doing larger, more sophisticated deals. It was one of the larger hospitality lender. So it refined my skills and grew my skills in many more ways than just being a real estate investor focused on multifamily at Sterling. And then it was really big on building my relationships, right? Real estate and most businesses are a ton about your skill set in that industry, but it's also your business connections and relationships in that industry. And it enabled me to kind of grow in that facet as well.
Do you mind explaining what core plus real estate is?
Well, I think real estate is described as core, then core plus, and value add, then opportunistic. These are all a way for someone to define kind of the risk and return profile of any particular real estate asset you're looking at. So for a core asset, you would think the risk is low. Um, the long term, it might have long term stable leases, or it might not have any sort of capital improvement needs. It's kind of like running, and you kind of like put it away and not think about it. Core pluses and value add are kind of they kind of mesh a little bit. This is a situation where there's more moderate level of risk. There's some maybe the asset might be 80% occupied in a market that's 90% occupied, and someone has to go in and do something to fix it. It could be because I'll give you an example. A core asset could be something that was built in the last 5 years and it's 95% leased. A value add or core plus asset could be it was built 10 years ago or 20 years ago, and somebody came in and renovated, let's just say it was 300 units, someone renovated 200 of them, and they never got to the other 100. And now it's value add because you can go in and renovate the other 100 and then get a better return, but somebody has to go and do that work. So that's value add. Opportunistic is like something that's like the highest level of risk. It could be that there is no building, there is no apartment building, but somebody wants to go buy the land and then go build it. That's opportunistic because the risk is much, much higher. So core plus, value add, opportunistic, there's just a spectrum of like low risk to high risk. How stable an asset is versus how much work is needed to stabilize it is how to think about it.
That makes sense. In 2018, you moved to Pimco and eventually became the executive vice president. What type of real estate were you involved in here?
Yeah, so my move to Pimco was because GE had gone out of the lending business, and there's a longer story as to why they left the business, but it was a great business, and they exited for reasons beyond it not being a good business. It was more about regulatory pressures, not only facing the banking community, but also facing these large investment firms, even if they weren't banks, because GE had become a big, large, while it made healthcare machines and jet engines and was involved in energy. They also have a very large capital business, like they were a bank, but they weren't a bank. But the government said, well, you're so big, we might want to treat you like a bank. And GE said, well, we don't want to be treated like a bank, so we'll just become smaller. So that's why GE left the real estate business. But that's what created the opportunity for places like Pimco to be in the lending business, because the entities or the institutions like banks and GE Capital, who used to provide owners with debt capital, were shrinking or were not able to do as much. So then companies, private companies, were able to build their own businesses in a redefined manner to go out and make loans on a subset of these type of projects, these real estate projects that the banks no longer wanted to, or they would have if GE was around, but wasn't around anymore. So that's what I did at Pimco. I was fortunate to join a great institution and help start their first foray into in a dedicated manner into commercial real estate debt in a private form.
What did your typical day entail?
So our business then and our business today is around going out and speaking with owners of real estate who have projects that they need to finance. So we typically focus on what we talked about this earlier, not the core, but the more value add, core plus value add opportunistic segment of real estate projects, which banks are not really as open to financing because they don't like the risk, and many times they don't understand the risk, um, or their regulatory framework, the way they're managed because of some constraints that they have, doesn't allow them. Um, so what we do is we go out and talk to borrowers, owners, and sometimes mortgage brokers who help owners um, understand their financing needs, look at what they need to finance, whether they're buying it or they already own it. So when they're buying it, it's called an acquisition loan. When they're already own it and they need to pay off another loan and take on a new loan, it's called a refinance. We talk to them and try to understand their business plan around how they're going to take this asset and make it core, make it stable, and then how much we're comfortable. Once we get comfortable with their business plan, how much we are comfortable lending to them at what interest rate and what kind of structure and conditions we want to have around making a loan to them. Remember, I mentioned this before. When you make a loan, you get your interest and you want to get your principal back. You don't get anything more, right? So and that's why it's your collateral. Your collateral is just the real estate, and we talked about this earlier. So you want to make sure that you think that what the owner is going to do is going to create value, so that the risk of you getting your money back is very low. So you have to do a lot of study, analysis, your own diligence, your own comp study, right? You just don't take what someone's telling you, you go and understand it. Now, fortunately for me in my business, we focus on very large loans. So it tends to be with very sophisticated, very seasoned, experienced owners. So often that mitigates a little bit of the risk because they're very strong academically and they have a lot of experience, and they know what you're going to be looking for. So they've already kind of done that assessment. Remember, they're buying it, so they have to. They're first to lose money if something doesn't go right, right? So you're aligned with them, but you still have to do your own work. So day to day, to summarize, we're either looking at new opportunities, we're continuing to underwrite, or another way to say it, study the opportunity and the business plan, and then we're making proposals on where we want to lend on that potential opportunity. And if we're so lucky to get the opportunity to lend on it, then we have to go through what we call a diligence process and a documentation process, which means we have to go see the site, we have to look at the reports, we have to read the reports, we have to understand if something that the reports are saying that we didn't understand initially, how to address it. And then eventually we have to do a loan document, which is a legal process. And then we have to close and fund the money. So day to day, we're doing every piece of that depending on where we are on any given transaction.
You said you were involved in commercial real estate credit at Pimco. Can you give some examples of some of the institutions or people that you were lending to, like what they looked like?
Yeah, look, I mentioned large institutions. So generally, when you're working on large loans, you're lending to private equity firms or very, very, very high net worth individuals who have a large portfolio of assets. We tend to focus on folks that have a strong experience in not just real estate, but particularly in the sector that they're buying. So, for example, it'd be tough for me to at least get comfortable quickly with someone who's never bought a hotel before and they've only owned apartments in the past, right? So without giving any names, it's generally large institutions who have, tens and tens and tens of billions of dollars of real estate and have been investing in real estate for a long, long time.
I see. You recently moved to Wellington Management earlier this year. What is private real estate credit?
Yeah, private real estate credit is just the same thing as what I was doing before. The word private is just that the dollars or the investments that we're making is coming not from a bank deposits, because that's if you're borrowing from a bank, they're coming from either a bank's balance sheet or deposits from individuals like you and I. Private real estate credit just means that we are going to in our own investors and are raising money from them, and they're giving their confidence in us to go and invest that money on their behalf. The word private also means that when we make a loan, we we hold it, and we don't. It's not something you can trade. So, have you heard of commercial mortgage-backed securities?
Yes.
Okay, so that's not private real estate credit. That's public real estate credit. So sometimes what happens is a borrower will come and ask for a loan, and a bank usually will take that loan and create it into a security, just like buying a share of Apple stock. It's a security, and it can be traded almost instantaneously, right? So that's a public credit. It's no different than a bond on a company like Apple, right? So private real estate credit just means that it's not readily tradable over some exchange. It's in what they call loan form, and if you can still trade it, you can still sell it, but it's not as instantaneous as if it was a public real estate credit.
I see. So not as widely available. It's more.
It's not as liquid is the right way to think about it. Maybe widely available as well is probably appropriate, but I think the distinction is more about how liquid it is. It's still liquid. Liquid means you can sell it and buy it and sell it. It just isn't as instantaneous. That's what private real estate credit means.
I see. What unique opportunities do you see in this role that you haven't had in prior stages of your career?
Well, I've been fortunate to really have a lot of autonomy and the ability to build a team and grow a team and grow a business in the past. I think just the opportunity at this new organization enables me to build something from scratch. Um, so Wellington is a very large asset manager, has a 100-year-old history in asset management. The alternatives business or the privates business, it's somewhat synonymous, is new, certainly in commercial real estate. So the the fact that we're starting something that doesn't exist today is really, really exciting for me. And the prospects for me are to not just start a business, but to start a business with a lot of scale and growth in mind.
What does your day to day look like now, and what role do you play?
So I'm fortunate to be the team lead for the business. So day to day, I will um, help oversee the team, work with our clients or our investors to gain their confidence, to go then procure loans from folks that we've known for a long, long time, and then eventually make the investment decision to make the loan, and then go through what I talked about, the diligence and the documentation process. That's my role as a leader of the team, as a steward of the capital and as a uh, person who represents the company to bring in the opportunities.
How have you seen change in your field over the past 15 to 20 years?
Yeah, I think a lot of the change is what around what I mentioned earlier is after the GFC, which was the global financial crisis. Um, a lot of the banks, see, in the U.S., the commercial real estate credit market is nearly $6 trillion large. It's pretty big, and 50% of that 6 trillion comes from banks, and banks are very, very meaningfully uh, involved in making loans for on commercial real estate assets, and they'll continue to be. But what's happened is after the GFC, because of some of the risks that were misunderstood or not understood well enough, the the governing bodies put in some regulations that made it maybe harder, certainly harder, but redefined the way that these banks can make these loans going forward. And that's changed the way that they're going to participate in the future. To say it some other way, the banks are reallocating and they're rebalancing and redefining the way they want to be part of this business going forward. And because one of the things they're focused on is they want to be a little bit more senior in the loan. So let me explain. So if you were buying something for $100 and you wanted to borrow $70, maybe the banks in the past may have given the $70. But today they're saying, hey, we really want to do $55. But you, the borrower, still need 70, right? So what's changed in a big way is that there's this growth in private credit, which I'm involved in, where we're not as constrained and not as unwilling or not as uninterested in giving you the $70. Of course, it's going to cost you more than borrowing $55. So what's going on now, the biggest change is that there's this big void of that $15 in my example, and private credit lenders are growing to take share of that loan market. So the banks are still there, right? They're still doing, they used to do maybe 70, now they're doing 55, right? But then the private lender or private credit is coming in, providing that gap to finance the deal. So borrowers can still do what they want to do, and together there's a lending cohort that can provide that solution for them.
Shifting from the past to the upcoming years, what excites you most about the future of this space?
Well, I don't know if I could be any more excited than I am today. I enjoy what I do. So to continue to do what I enjoy doing in a market that I really understand well, where I have some really good friends and colleagues and relationships, really excites me to continue to do what I'm doing. I think what's most interesting is, see, I've always been a quote unquote private lender, because I remember I mentioned early in our dialogue that I used to be at GE Capital. GE Capital was a public company, but it was doing private loans. It wasn't in the securities business. It was in a bank. So I just think that the opportunity set, the amount of transactions that will migrate more towards private credit is interesting for me and the team that I get to work with, so that we can build a pretty interesting business in the foreseeable future.
So, For everyone out there, what are the opportunities retail investors have now to invest in real estate?
Is it real estate or real estate credit? Probably both, right? So when they say retail investors, I think you're talking about high net worth investors who uh, are not like a pension fund or an insurance company that either own or lend against real estate, because they do both. Um, I think there's just a growing opportunity for the retail investors to access these type of transactions through managers like myself that wasn't available structurally in the past, and they're just going to be able to diversify their investments into what is otherwise just as safe but higher yielding. And the reason why it's higher yielding is because it's not as liquid. But it's still, remember I said it's still liquid, it's just not as liquid as a security. So the opportunity is for them to take their wealth and continue to grow it and compound it with the with the with the ability to access these type of opportunities in the future.
On a lighter note, how do you spend your free time? What are some of your favorite hobbies?
I love doing real estate loans. uh, I'm a pretty avid poker player. I try to play as often as I can. I did start weight training a little bit because I'm getting older and I needed to think about my health a little bit more acutely. So I am weight training and exercising a ton more. But I have two young boys, 15 and 12 this year, and I realized that they're going to be out of the house in 4 to 7 years. So I'm trying to spend a ton more time with them. So that's kind of keeping me busy and excited and happy. Um, and then travel and eating out at new restaurants and new cuisines has always been a passion of mine, especially when you live in New York. There's so many great uh, restaurants and cuisines and communities that you can access without going and traveling the world, because you're constrained with travel and work and life and family, that I try to take advantage of when I can.
Do you have any favorite cuisines or restaurants?
So I really, really like Indian food, but Indian food outside of my mom's house is tough to get that's as good. Um, but there are some new Indian restaurants that have come about in recent years after my 40 years in the States. So there's a restaurant called Gup Shop, which I really, really like. There's another restaurant called Ada, which I really, really like. That's for Indian. There's a Portuguese restaurant called Leitão, which I really, really enjoy. I think I've been there like 7 times in the last month. Um, and then there's a restaurant that I've been going to since I was at NYU called Sevilla, which is on Charles Street, which is a Spanish restaurant. It's pretty no frills, but the food is just amazing. So those would be, if you ask me, if you came into town and asked me, hey, what restaurant should I go to? I'll give you those three. And it's not for the scene. It's not for the glitz and the glamour. It's just for good food.
Guess I'll have to try some of these out
Yeah,
soon.
let's do it. Let's do it together.
Now, for the question I ask every guest on my podcast. For kids in high school and college looking to enter the world of finance, what advice would you have?
It's a good question. I think first, I think you should keep your options wide and keep yourself open-minded. Finance is such a wide industry, um, and it's changing. And candidly, I don't want to scare you, but I want to be honest and I want to guide you. I I'd want you to consider how AI might affect a young person going into finance, See, earlier I gave you the example about going and shopping apartments, and now all that information is on the internet, and you can put out all these spiders, and they can go and pick out all the rents at all the comparable properties. And then tomorrow, you won't even need someone to do that because a chat box is going to deliver it based on a prompt. So I think you have to just keep your eyes wide open. If you want to be in finance, that means you want to be in business. And that means that you should talk to as many people as you can in in what they do and try to see what is interesting to you. I don't think if you want to be in finance, I don't know if you necessarily should be thinking about investment banking or sales and trading. I think you should be thinking about an industry or a product or a segment of the market that you're gravitating to and you want to study further, and then think about what kind of business role you can play in that industry or product. I also think that you have to realize that you have a very, very long life to live. So focus on finding what you will enjoy first and not think about, I want to be in finance. I think what you're doing, Meher, with these podcast series is a great avenue to hear folks speak about what they're doing in finance. And I think, don't think about how you get to the next step, because you might get to the next step of something you don't want to do long term. So start to think about what you think you'll enjoy, and then find which facet of that business you will fit well in. Understanding that knowing the fundamentals of finance and accounting are very important to being in finance. If that makes sense. I think everything boils down to just working hard, seeing as much as you can, talking to as many people as you can, listening to as many people as you can, and then taking a breath and saying, okay, this sounds interesting, let me go try it, versus saying, this sounds interesting and this is what I'm going to do.
Thank you so much for this wonderful piece of advice and taking us into the realm of real estate. I appreciate you being on the show today.
Thanks a lot. I really enjoyed joining you.
Thank you for listening.